Welcome to your Wealth Engine, the show that helps you create, grow, and protect your wealth through the power of free market capitalism. My name's Andrew Stotz, and I've got some exciting stuff for you today. Let's take a look at the topics I'm going to cover today. Basically, it's all inflation. If you ever want to know about inflation, we got it here. So the first thing is, the title of today's episode is U.S. oil pressure, German crash, and China lag. So I'm going to talk about some detail on CPI. And first thing I'm going to show you is that the prior rise in oil prices is now feeding into the price of almost all other products in the U.S. Also, U.S. CPI has likely passed its peak, but it could remain elevated unless oil prices spike again. And the lagging impact of high oil prices is likely to keep the U.S. core inflation high, which means Fed maybe continues to keep raising rates. And German leaders are crashing their economy. China's inflation is lagging a lot, but could bring future inflationary pressures to the world. I'm going to introduce you towards the end of this episode to one company that is a financially world-class company in Asia that you'll find, I think, very fascinating. And then I'll end with the three people I interviewed last week, talking about the mistakes that they made and how we can learn from them. Before we get started, my asset allocations haven't changed since last week. Basically, I'm 25% equity, 25% bonds, 25% commodities, and 25% gold. You can say I'm a little chicken. I'm just not ready to make a big bet on equity right now. And so that's a very heavy underweight equity and also a big underweight the US right now. So feel free, as we go through this presentation and as I go through this episode, feel free to ask any questions. And also, there's a lot more to add to what I've got here. But let's first start off with this prior rise in oil price now feeding into the price of almost all other products in the US. So let's get into this and see. Here we have US CPI in September, which came in at a higher than expected 8.2%. But if we look back at August, it was 8.3. At July, it was 8.5. And in June, it was 9.1. So on a year-on-year basis, it's actually kind of peaking. Now, people like to look at month on month and other things. I almost never look at month on month. I always try to look at the longer term trend. And so right there, you can already see a little bit of peaking in inflation, but we need to go in more deeply. So has US inflation passed its peak, or will it continue to rise? That is my thinking practice for you and for me. And that's what I'm going to try to address today. Now, US inflation has three parts. Food is a small part, but food prices have been accelerating since January. What you can see in this particular table is that I'm showing you the weight in CPI. And so I'm just going to grab my pen. There's going to be a little bit of a masterclass in inflation. But the weight in CPI is about 13.6 for food. And you can see that the food component of CPI has accelerated significantly, up from 7% year-on-year increase in food prices in January to 11.2. That is a major move up in food prices in the US. Now let's look at energy, the second component of the US CPI. And that energy component comprises about 8%, 8.2% of US CPI, which you would think to yourself, that seems a little low because energy's in everything. But this is specifically and mainly gasoline prices in the US, or what we say petrol around the world. And what you can see is the impact of falling oil price is feeding in right here. In January, this was year-on-year growth of about 27%, and now it's down to 19.8. Still high, but decelerating. So right there, we can see that the impact of oil price comes down quickly in this component of GDP, or sorry, of inflation, of CPI, but it's only 8.2% of overall inflation. So the third thing I call everything else. We'll look at that in more detail in just a bit, but you can see about 78% of US CPI is what I call everything else. And so it's a huge component, and it's steadily rising 6% up to 6.6% in September. So what I would say is it's not out of control yet, but it's rising. And you'll see why I think that it's going to continue to rise. Now we can multiply the weight. So let's just take the weight here of 13.6, and we can multiply it times 11.2, and we can get the contribution to the 8.2% inflation. And we can see of the 8.2% inflation in September in the US, 1.5 of it came from that very small 13.6% component, food. That's pretty significant. Now, if we look at energy, you'll see that energy contributed 1.6% of that 8.2%, but that's down because it was contributing in January 2%. So right there, that is a decelerating impact happening from energy. Now, also, remember, as I go through this, feel free to ask questions about anything I talk about and any other questions that you may have. I want to welcome everybody here. Monday morning, 7 a.m. What are you doing? Are you sitting in your bed watching on your phone? Are you in your car? Are you at the office? I'm at my home office and spending this time with you. So the next one is the price of everything else is large and rising. So here we can see that everything else has a component. The component weight is 78.1, and it's 6.6, which means that it's contributing 5.2% of the 8.2. So this is the biggest component, and you can see it's accelerating. And it's gone from 4.8 in January up to 5.2 in September. So if we bring it all together, we can account for all of these items and understand that inflation was 8.2% in September. And we can see most of that's coming from everything else. So what is everything else? Well, we'll go into that. But let's first look at the key points I want you to understand about this. Number one, US September inflation came in at 8.2, which was slightly higher than expected. This raises the question, has US inflation passed its peak, or will it continue to rise? Well, what did we see? Food is a small part of US CPI, but food prices have been accelerating compared to January. Energy is also a tiny part of US CPI, and its rise is decelerating. And everything else is a big part of US CPI, and it is rising steadily. And though a small part of US CPI, food's rise is having an increasing impact on CPI's rise, and energy being small and its rise is decelerating. Hence, its direct impact on CPI is small and has slowed. And the price of everything else is large and rising and is the driver of almost all of the rise in US CPI. The bottom line, the prior rise in oil price is now feeding into the price of almost all other products in the US. Rising oil prices takes a long time to feed through the economy. In particular, companies take time to increase their consumer prices, but also it's the case that companies take time to adjust themselves to these rising prices. And remember that energy prices feeds into everything. So now let's take a little bit of time and look at how US CPI has likely passed its peak, but it could remain elevated unless oil prices spike again. That's right. What I'm saying, and maybe I'll just take a moment to make this very clear. The research that I'm done today, that I'm presenting today, shows me that the US inflation has probably peaked, but it's not going to go down because that oil price impact is going to be feeding into all the other elements of prices in America. And what does that mean? The wild card is if oil prices spike again, well, we're going to get another spike flowing through CPI, which could last 6, 12, 18 months. Remember, there is a lag effect on this CPI into the other components of CPI. So oil feeds into everything else with a lag effect. All right, let's go into the next section. And I want to start off by looking at, again, we have CPI peaking. We've looked at this chart, but now let's bring in food prices. And you can see that those CPI is kind of taking a breather, which I can show right here. It's kind of taking a breather right there. But food prices now, the acceleration's happening. Now, hopefully, food prices can take a breather there, but it's possible that food prices could continue to rise as the impact of oil prices feeds into the overall economy. And there's going to be a steady rise of everything else. Now, what you can see is all other, or what I call everything else. All other is a big component. It's a little bit more stable. This is what the Fed would call core inflation. But core inflation, I see that it's starting to accelerate again. And that acceleration, I think, can continue as oil prices continue to feed through. So the result of that is we probably end up with inflation being about flat in the US for the next maybe 6 months. Let's take a moment and say hi to everybody here. I know we've got a bunch of people on the show right now. I want to say hi to Pichet, who's on, and Jing Jing, who's also on. Good morning. And Peter, good to see you, and good to see all of you guys. Feel free to ask any questions as we go through. So if there's no major oil price moves from here, it could be the peak for US CPI. Here we can see that the energy component of CPI is the brown line and the red line is the CPI. And you can clearly see that that has come down. But the feed through of high oil prices could keep food and everything else high, meaning no extreme fall in US CPI over the next few months. And in addition, of course, there's a rising base effect where all prices have been rising quite a bit. In fact, you can look at that base effect right here by saying that inflation used to be flat and now we've had this rising. But by this time, any future inflation that comes is going to be compared against a very high level of inflation. That base effect is going to prevent inflation from going up to 12, 15% in America. And these are the reasons why I think that inflation in America has probably peaked and is not going to accelerate unless oil prices really shoot up. So here we can see what I mean. This is a chart that shows the oil price, WTI, West Texas crude price, and I've rebased the oil price and put it on the right-hand scale. I start the oil price, the green line, at 100. So I'm starting it at 100, and that's the green line right here. And it's just been flat all of these years, and then boom, it started to accelerate up into the 2007 boom right here. When we had 2007, we had a huge boom going on. And then, of course, the 2008 crash that it came down. Then it rose again. And as it rose, we can see that most of the time when oil is rising, it is driving up the blue line, which is the inflation. It's not a perfect correlation, but it is a reasonable one. So what do I want you to understand from this? And remember, first, US CPI appears to be peaking. Second, food prices have been the recent driver, but had a slight deceleration in September. And there's been a steady rise of prices of everything else. If no significant oil price moves from here, it could be the peak for US CPI. But the feed through of high oil prices could keep food and everything else high, meaning no extreme fall in US CPI over the next few months. In addition, the rising base effect will likely keep CPI down. So the bottom line, US CPI has likely passed its peak, but it could remain elevated unless oil prices spike again. And I think that I just want to talk for a moment about this. This probably is, there's some contrary nature to this. What most people probably are thinking right now is that inflation is going to get higher and higher and higher. But from this research, I would say that's not going to be likely. It's possible. If oil prices really shoot up from here, yes, inflation could go higher. If countries, and particularly the US, lose control of the pricing mechanism in their country, yes, it could go up. But if things stay as they are, we have passed the peak for US CPI. Now, again, I want to welcome everyone. I see Rajan, good morning, good to see you. And also, I see a message from and a question from Jet Sada. It says, from your opinion, how long market returns will go back to normal return? Well, right now we're going through kind of a crash, and I would suspect that we may be another 10, maybe 20, maybe 30% down on the markets. It's possible. But at some point, I think we'll hit a crash. Look at what's happening in countries like Germany, and basically they're bringing a crash on pretty fast. Now, also keep in mind, Jessica, that the Fed is actually orchestrating a crash of the US stock market and of the US economy. And that's part of the reason why my positioning has been somewhat neutral or defensive in the strategy. So I would say that we probably have 6 to 12 months of just terrible, frustrating equity markets. It could be 3 months to 12 months. And then after that, we start to see things come back. Now, all bets are off if what happens is we move into a world war. If we go into a world war, which I think is very possible now, given the stupidity of our political leaders, which they're demonstrating every day, they actually could lead us into that situation. And in a global war, the only thing that's probably going to do well is commodities, because inflation is always pushed up during wartime. I think next week I'm going to talk a little bit about that. But for this week, let's continue on. We'll go into the next part of this presentation, and that is, hold on, where am I? There I am. Let's talk about the lagging impact of high oil prices and how it's likely to keep the US core inflation high. So let's dig in a little bit more deeply into the food numbers. We can see that higher energy and fertilizer prices are feeding into food, meat, fruit, and vegetable prices. In fact, food at home is the biggest component of food, and that's 8.5 in weighting. And we can see its acceleration that's happening compared to the beginning of the year compared to now. And so I would say that that is part of what's happening with oil price now feeding into these items. And so of the 1.5, 1.1 of that is coming from at-home food. Funny that I moved to Thailand 30 years ago, and it was a really the cheapest thing that we could do in America was make our food at home, not go out. But here in Thailand, of course, just on my soy at Sukhumvit Soy 12, I can walk down the street and I can get the most amazing food cooked by the kindest, nicest mekha and the vendors on the streets, and bring that home. And so, but at home is the most expensive area. So let's continue on. Remember, if you have more questions, feel free to ask as we go through. So now let's break down energy. Fuel and electricity have about equal weight, and oil is retreating, but not so with electricity. Oil price is slowly feeding into electricity. That's what's happening. So what we can see is that we are seeing the weight. Now, we can see that the weight of fuel prices is about 4.6, and that's actually risen substantially. But yet oil prices, mainly this is gasoline in America, we call it, or petrol, has slowed down. It's decelerated. And so it has a decelerating effect on US CPI, going from 1.6% contribution in January to 0.9. But what's happening here is that the weight of 3.7 of electricity is, moderate. It's not a big item, but you can see it's rising. What's happening here is that this is causing the inflation component of electricity to have an impact on inflation. Why is that? Because electricity is a lagging measure. Ultimately, the inputs to the electricity process, whether that's gas, whether that's oil, and whatever that is, tends to adjust quickly. And then the governments and the utilities that provide electricity tend to adjust slowly. Now, let's look at everything else, which is really commodities and services. So vehicle prices are falling, services are increasing, especially shelter. So let's just go through this first. We can see that commodities, which is mainly vehicles and apparel, meaning clothes, right, is about 21%. That's a huge item. And we can see that it's crashing down because used car prices have come down, new car prices have come down. And this is part of the supply chain bottleneck starting to work out. And that's causing the impact of the cost of cars as the supply of cars has increased, and also the initial demand. There was pent-up demand when there was no sales in 2020, 2021, and that pent-up demand has probably worked out, and the supply has worked out. And as a result, vehicles in particular are not a major impact, only accounting for 1.4% of the total 8.2%. But what is a major impact is shelter and medical, which are the two major components of services. Services account for 56.8%, and we can see that they are rising over time. Again, it takes time for rising energy prices, rising electricity, all of the rising prices go slowly into shelter and medical. And as a result, we can see that this services component contributes about 3.8%. That's a very, very big contribution from services. Now, I want to just go deeper into this and look at shelter. Shelter meaning homes. Homes that people own or rent account for about 32.5% of CPI in the US. That's different from other countries. In, let's say, emerging countries, developing countries, what you have is a lot less spent on shelter and a lot more money spent on food. So here, what we can see is that these items are rising. The rent is rising, basically, and we can see that it's have a rising impact. Now, this is a very slow, lagging price impact, and I'll tell you why. Because they use something called owner's equivalent rent. And the economists at the U.S. Bureau of Labor Statistics see a home as rent that the owner would have had to pay if they were renting their home. In the eyes of the economists, homes are considered capital or investment goods. They're distinct from the shelter services that they provide, and therefore they're not considered consumption goods. So all costs of homes are considered capital investment, not consumption. As a result, spending to purchase and improve a home is treated as an investment and not consumption in the CPI. Mortgage costs, property tax, real estate fees, most maintenance, and all improvement costs are part of the cost of the capital goods, and they're not treated as consumption items. So housing price changes are very slowly reflected in US CPI. A lot of people complain that because they use owner equivalent rent, it means that the adjustments that are happening in the property market, all the rise that has happened over the last 5 years that's been spurred on by super low interest rates, mortgage rates, that hasn't been fully reflected. And then, of course, the fall that's happening in the property market will take time to be reflected. And this is one of the reasons why I believe that the inflation is not going to come down, but I don't think that we have a spike. Now, I think Peter has a question, so let's look at what Peter says. If the U.S. is getting into recession, what will happen to emerging markets? Could you share your opinions, please? Yes. So if U.S. goes into recession, it's definitely bad for everybody in the world. And I think that U.S. is going into recession, and that's why we're seeing the stock markets around the world, and particularly the U.S., has been adjusting for that slower growth. So remember that the market, the stock market, is a leading indicator. If people start to believe that the U.S. is going into recession, then the markets adjust, and the market has been adjusting. So what I'm saying is that if things are worse than people expect, which I think is possible, I think that Jay Powell will just destroy the U.S. economy and the global economy. If he keeps raising rates like this, he'll cause a global recession. However, the stock markets, number one, are already adjusting for that, number one. Number two, many countries outside of the US don't have as much debt because they couldn't issue a lot of debt. They couldn't flood the world with their currency, or the value of their currency would have gone down. It was the US that could do that. So I think that that's my kind of thought as of right now. So the next one I see is Jessica says shelter price might be slowed down by the rate hike. Yes. So what's going to happen there, Jessica, is that the interest rates, mortgage rates in the US have skyrocketed. They've gone from, my niece basically borrowed money, got a mortgage loan for her house, 30-year fixed. And I believe her rate was about 2.9%. So it was very close to the bottom. Now she's locked in that rate for 30 years. You can imagine she's never going to sell, because if she wants to sell that house and buy another one, she's going to have to apply for a new mortgage loan, and it isn't going to be 2.9%. It's going to be about 7%. And that's 7% plus the slowdown in the economy of demand, the slowdown in demand that Jay Powell's trying to orchestrate. Combine those two things, and you have a housing market crash. And prices in the housing market are massively high, especially compared to the stock market. One of the reasons why the US market, the housing market, is in such a bubble is because it's fueled by the government. Just like student loans, the government has come up with all kinds of ways to channel money into housing, and they constantly create a boom bust cycle. They did it in 2007, and they did it now again. And we see that happening all the time, whether that's student loans or whether that's housing loans. The government gets involved, and every time that they do, they cause a bigger boom bust cycle. But the point that I would make, Jessica, is that when the housing prices start to crash, as they have been doing now, that is going to be very slowly fed into the owner equivalent rent. In fact, owner equivalent rent is probably just going to be rising and rising and rising for the next 6 to 12 months before it even feels the impact of the crashing prices. And that's why I think that CPI in the US is going to stay high. So now let's bring it all together. Rising oil is feeding into core CPI, and its fall will take a while to be reflected. And I've also brought in what's happening here. At the bottom, I've provided you some supplemental items of interest. What you can see is the year-on-year. I'm looking at the year-on-year change in percentage terms, right? Because everything in this is in percentage terms of oil price. And you can see it was up 60% in January of this year, and it was up 17.6% year on year in September. So the impact's coming down. But if we look at housing price index right now, we can see that it's still pretty high at about 20%. And the result of that is that the housing price crash is slowly feeding into prices and slowly feeding into CPI. And that's going to keep CPI high. So feel free as I go through this to ask any questions. And Dead Pooh says, you love Thai food. What about Thai stocks? Okay, well, I definitely love Thai food, but I have to admit, I love Japanese food, I love American food, I love hamburger, and I love Italian food. I love all kinds of food, but Thai food is especially spicy and tasty, so I love it. The Thai stock market, is interesting to me right now. I've talked before last week about the Thai stock market, that it's getting attractive. And I would say one of the things that I like about Thailand in particular is that the country during the COVID crisis, it was tough for everybody in Thailand. The government was not handing out money like the US was. The government was not pumping cash into the economy like the US. The Thai government wasn't printing money like the US. And so in some ways, the economy just stood still. And what happened is what should happen when you have a crash, demand should also crash. And that's how a market adjusts. But if you have a crash in particular in supply, as we had globally, but you stimulate spending of the by the population, by people, what's going to happen is that stimulation in spending when supply is down is going to cause inflation. And Thailand didn't go through that so much. So I'm not so worried about Thailand's economy. And I would say I'm relatively positive on the Thai market relative to other markets in Asia. But that's a topic for another day. So let's review what I want you to take away. First, higher energy and fertilizer prices are feeding into food, meat, fruit, and veggie prices. Fuel and electricity have about equal weight. Oil is retreating, but not so with electricity. It's going to be feeding in. Everything else, well, vehicle prices are falling, services are increasing, especially shelter costs. And rising oil is feeding into core CPI, and its fall will take a while to be felt. The bottom line, the lagging impact of high oil prices is likely to keep U.S. core inflation high. Again, let's go back to my thesis, and that is U.S. inflation has probably peaked as long as we don't get a further spike in oil. But it's not going to come, U.S. CPI is not going to come crashing down because there's too many elements of rising prices that are feeding in slowly into the overall economy. All right, let's look at German leaders. I don't know what is wrong with German leaders. They're just crashing their economy. And China's inflation is lagging, but could bring future inflation pressures to the world. Now, remember, only a couple of like a year ago, China didn't have almost any COVID, right? It wasn't a big deal. And then all of a sudden they went to this COVID crash, COVID lockdown. Well, I think you could have the same type of thing with inflation. So let's just dig into this. Here we can focus on the top 5 developed and emerging market countries. And what I've got is US, Japan, Germany, UK, and France as the largest. And as you can see, I've ranked them. We can see that developed countries have about $52 trillion worth of market capitalization, GDP. And the main one, of course, is half of that is the US, then Japan, Germany, and down to France. Now, in emerging markets, they account for about 38 trillion of GDP. And China, of course, is about half of that, just like US is about half of developed. And we can see India and then Korea. Now, I am using MSCI region, not IMF or other suppliers. Reason why I use MSCI is because I'm an investor. And from an investment perspective, Korea is still ranked as an emerging market. And that's because of some of its restrictions that it's got going on there. But here we can see Germany's September inflation is a large rise. We can see that item right there. If it shows NA, it means that I either can't yet calculate it, or it means it has not been, let's say Japan has not disclosed its September CPI. And we can see that France is down a bit. China is very low. You see how low inflation is in China? I mean, it's gone from 2.1, 2.2 up to 2.8. So it's definitely rising, but it's still a very low number. In fact, it's suspiciously low. Something's going on. Either the calculation of it is a bit wonky, or it could be that the economy is just actually pretty weak. And we can see that Russia has been in a steady fall. It peaked at 18, and now it's down to 13.7. And Brazil also peaked at about 12.3 and has come down to 7.2. So let's look at this in graphic terms for a moment. Inflation has been higher in the developed world. We can see the developed world in this particular chart is above the overall world, and the emerging markets have been lower. But we can see also that that's being depressed by China's really low inflation. So let's look at it. US and UK have had high inflation. Germany is accelerating most in the developed markets. This gives you a picture of what's happening. Basically, you could say that inflation is somewhat flat recently, except in Germany. Now, let's just look at Germany. Here we can see that German political leaders are driving inflation to the moon, and they're crashing their economy. The producer price index is now up 40% year on year, and that is slowly and will slowly and steadily fall into and drive into consumer price index. And German consumers are just suffering with higher and higher prices, and it isn't going to end, because we are going to see a follow through of this item coming in here. And you could see that German CPI could go as high as maybe 20%. It's going to be brutal. I would say that Germany is moving into a dark depression. Why are the political leaders of Germany abandoning their people like this? I just can't understand. Why do you think it's happening? So now let's look at emerging market inflation, which has been low thanks to extremely low China. So again, China accounts for about half of the GDP of emerging markets. And here we have China's inflation. The CPI is down at about a little bit over 2%. That is extremely low. That's either a case of massive supply in the Chinese market and nobody can increase prices, or a collapse in demand in the Chinese market, so nobody can raise prices, or it could be that it's just not a great measure. That's something that we can ask. And you can see also that Russia has been seeing its inflation peak but coming down, and the same with Brazil. But these are pretty small in the face of things. My point is that remember how China didn't have any COVID, and then all of a sudden it did, and we can see that happen. I think that you'll see that Chinese inflation could start to rise unless the economy just really stays terrible. So what are the key points? First, we looked at the notable countries in the top 5 of developing and emerging markets. We saw in the developed markets that the US September inflation was flat. Germany September inflation was a large rise. France September was down a bit. Emerging markets, we saw that China's September was very low, and Russia's September has been in a steady fall, and Brazil September has also been in a steady fall. Inflation has been higher in the developed world. US and UK have had high inflation, and Germany is accelerating most in the developed markets. German political leaders are driving inflation to the moon and crashing the economy. And emerging market inflation has been low thanks to meager inflation in China. The bottom line, German leaders are crashing their economy. China's inflation is lagging, but could bring future inflation pressures to the world. Remember, China is the manufacturer of the world, and the result is that that could pass out into the world and keep inflation high. The best outcome would be that inflation in China remains low, but there is a risk. All right, so before I move into the last segment, the second to last segment of this show, where I'm going to talk to you about a financially world-class company, I did see a question come in, and it says, China reopening would also bring with it capacity to produce additional supply, not just additional demand, wouldn't it? I think you're right. If China reopens and starts to crank all that, it will bring more supply out into the market. But also keep in mind that that really what matters is in the domestic economy also. And I think that they've been able to keep inflation down domestically. And I think that if they start to lose control of the domestic inflation, then there's a problem. But, I would say it's probably a 30% chance that China could export inflation to the world. And right now, I would say 70% chance they're not. And so you would be right in this case. But if you start to see that CPI accelerating in China, it could be an issue. All right. So let's talk about this company. Can China's Ning maintain its financially world-class status? Well, welcome to this valuation masterclass case study where you'll learn about interesting stocks and how to value them. What's interesting about Ning is that it expanded its gross margin by 15 percentage points over the past 10 years. That's incredible. So remember, this is for information purposes. It's not investment advice. So this Ning is in the consumer discretionary sector in China, and it's China's leading and fastest growing sports brand, or let's say among them. There's three things to know about this company. It's riding the Chinese e-commerce wave to drive top line growth. It's got efficient inventory management, and that's resulting in margin expansion, and strong cash flow is proof that investments are fruitful. Here's some key statistics about the company. Consensus is about an upside of 61%. There's 42 analysts covering it. Right now, there's no dividend yield. The PE is about 48 times. Wow. And price to book is 7.3. Now, that PE was at the end of 2021 earnings. You're going to see that PE has collapsed now. 52% of revenue comes from apparel and 42% from footwear. And then equipment and accessories are 6%. It's all sales are in China. And let's do a little shout out to leadership. Of course, Ning is the chairman and joint CEO. He's a retired gymnast, won 3 gold medals at the Olympic Games. And Kosaka Takashi is the joint CEO. He's formerly the CEO of sports giant Uniqlo's Korean operation. And that's also called fast retailing. So riding the Chinese e-commerce wave to drive top line growth. As of 2021, e-commerce made up 28% of Ning's revenue. That's a massive increase that you can see right there on the right-hand scale. It's at almost 28 for the blue line. China is expected to be the first country that generates more sales from online than in physical stores. So as a comparison, in the West, e-commerce accounts for about 15% instead of Ning's 28%. Boom. So now, efficient inventory management results in margin expansion. This is a fascinating chart where I look at the age of the inventory. The red bar is 6 months or less. The green bar is 12 months, over 12 months. And then the blue is 7 to 12 months. Of course, we want to see the red bar as high as possible as they have lower and lower months of inventory. It has a higher turnover on its inventory with a lower share of older and outdated products. Between 2017 and 2021, gross margin expanded by 6 percentage points, which is a huge improvement. Now, strong cash flow is proof that investments are fruitful. This chart, I try to look at the CapEx, which is the blue bar stacked on top of the dividends paid, and then above that is the operating cash flow. To lay the foundation for future growth, CapEx requirements are constantly rising. However, at the same time, Ning is generating strong cash flows that can easily cover investments and also grow dividends. Let's look at the company's world-class benchmarking scorecard. We developed this scorecard to better understand any company's fundamental performance. Any company that you're looking at, any company that you're running or you're working in, we can do it. So it measures a company's competitive position relative to global peers. We calculate a combined composite rank of profitability and growth called profitable growth. And number 1, of course, is best. 10 is worse. So where is Ning? Well, Ning has been defending a world-class rank. In fact, the profitable growth score has stayed in the top decile for 4 years in a row when compared against 1,000 large consumer discretionary companies worldwide. This, ladies and gentlemen, is a world-class company. And where is it coming from? Profitability or growth? Well, the main driver was high profitability. In addition, the company has an above-average growth rank. Analyst consensus sees 61% upside. It's a buy or a strong buy everywhere. There's 42 analysts with that upside. And what we can see is that it's trading at 1 standard deviation below historical PE ratio. The share price had crashed, PE crashed, and now the PE is down substantially. So there's 3 risks to consider as I see it. Geopolitical situation may hinder the company's international expansion, and sanctions by Western governments could prevent investors from investing in the company or in China, and failure to protect its own intellectual properties. So my question to you is, can Ning maintain its financially world-class status? I'll wrap up today's show by talking about 3 people I met this week, in the past week. Mahir is one of the people. He was episode 603 on my worst investment ever. And what I learned from him is don't count your chickens before they've hatched. He's a global award-winning trainer, speaker, and author. And he partnered with a friend to offer services to a government company in Mauritius. Suddenly, the company declared bankruptcy, nullifying the contract and ending the opportunity and causing a major loss. The lesson, don't count your chickens before they're hatched. Even if you have a signed contract, the deal is not done until the money is in your bank account. And let's talk about Hugh Grover, episode 603. Choose to listen to your gut feeling. He's the founder of Digital Sales Community. He is an expert in driving revenue. Hugh spent over 6 years studying a course he was uninterested in and working a job that he hated just because he thought that's what people thought was right for him. And what can we learn from this? If something doesn't appear right for you, listen and unpack why your gut feeling is off, and don't be afraid to make that decision. And finally, Harriet Mellor. Hers was episode 605. Do you have the time to invest and take action? She's a sales transformation coach, focus on sales, and she's the CEO of Your Sales Co. Harriet invested thousands of dollars in courses, programs, and coaches she never used because they didn't align with her values. The lesson we can learn is if you don't take action, you won't see any results from your investment, but make sure that they align with your values. And that is the end of today's show. I'll have a minute or two to answer any final question, and then we'll wrap up. So let's see. Did we get any questions? Arjun Sun says, compared to other crises in the past, is there any of them like this time and it's going to be worse than the hamburger crisis? I think that given the amount of debt that is in the world, it's going to be a very significant crisis. But that debt especially is in governments. And this is where it's going to be a very different type of crisis from what we've seen in the past. Most of the time when we have a crisis, it's a banking crisis, it's a property crisis, it's a company crisis. But now every single country in the world is struggling with, they've issued a huge amount of debt, particularly the developed countries. Their currencies are weaker and weaker. The dollar is only strong because it has the power and the military might to defend its position. But I would say that what you're going to see is a lot of stuff happening in currency. Now, if you're an investor in Thailand, one of the interesting things is that you are investing in mutual funds. If you invest in mutual funds, there is a hedge against much of the currency movement. So I just want to thank everybody for attending. Hopefully you learned something. If you have further questions, feel free to put those questions in the comment section, and I will see you next time.